Alright, imagine the stock market is like a giant farmer's market. Every stall is a company, and the fruits and veggies, those are the shares you can buy. Now, just like some apples get more expensive when everyone wants them, stocks go up and down based on demand. But when should you actually buy, hold, or sell your fruit? First up, time horizon. Are you shopping for tonight's dinner or to stock up for the winter? If you're investing for the long haul, think 5 years or more, those daily price swings don't matter as much. Next, risk tolerance. Can you handle your apples sometimes looking a little bruised? If market drops keep you up at night, maybe stick to the safer produce, or in stock terms, blue chip companies. More risk, more potential reward, but also more stress. Let's talk strategies. Some people buy and sell all the time hoping to catch every deal. That's called active trading. Others, like Warren Buffett, just buy good companies and hold tight, letting them grow over years. That's the buy and hold strategy. And history shows it often works out best. Now, when should you actually sell? Good reasons. Maybe the company changed so much it's unrecognizable, or you need the cash for something important, or you've reached your goals. Bad reasons. Selling just because everyone else is panicking, or because the price dropped a little and you got spooked. Remember, even the best apples have a bad day. Bottom line, know why you're investing, understand your appetite for risk, and don't let emotions run your market stall. That way you'll stay smart, and maybe even enjoy the fruits of your labor.